All right, so we'll get started as people trickle in. Good morning slash afternoon, everyone, and welcome to today's webinar hosted by the CHA, Deloitte, and Hydrogen in Motion. My name is Tony Saha, Marketing and Communications Manager at the Canadian Hydrogen Association, and I'm speaking to you today from Edmonton, Alberta, which is a traditional, ancestral, and ceded territory of many First Nations, such as the Cree, Dene, Anishinaabe, and Blackfoot. Nicholas, if you could change the slide one more time. So for those of you who are not familiar with the CHA, we're a national industry association established in 2009 with a history that spans over 50 years. With regional affiliates in BC, Alberta, and Ontario, we support our members with advocacy, communications, networking, and government relations. Next slide. We represent over 200 Canadian companies, academia, consultancies, research agencies, and end users who are developing, demonstrating, and deploying hydrogen technologies in Canada today. If you or your organization is not yet a member of the CHA and are interested in learning more, please feel free to reach out to me after this webinar. As well, we are co-exhibiting at the Canadian Hydrogen Convention, and we are the association partner. So if you would be interested in being part of that pavilion, please feel free to reach out about that as well. So some housekeeping rules before I introduce our speakers for today. Please note that this webinar will be recorded and held in accordance with the CHA's competition law compliance policy. Please feel free to enter any questions that you may have in the chat section. We'll be sure to get to them during the Q&A segment following the presentations, where you will also be able to turn on your mics and cameras as well. So introducing our speakers of the day. Next slide, Nicholas. Grace Kwan is the president and CEO of Hydrogen in Motion. Prior to that, she had a 25-year career spanning private and public sectors. And in 2018, she was recognized by BC Business Magazine as one of the 50 most influential women in STEM. Next slide. David Arthur is a Deloitte tax partner and is the global leader of sustainability and climate change for tax. David has 19 plus years of experience working with energy and resource client and industrials, helping them access government incentives and tax credits. And with that, I'll let David take it away.
Right, thank you, Tony. I'm just gonna move over to another deck. Bear with me a second while I get it up. And I'll start the slideshow. From the beginning. Here we go. Okay, well, thank you all for attending today. We're going to spend some time talking about the Scientific Research and Experimental Development Program. Give you a flavor for what it's all about. So we'll give you a summary. And then we're going to take a look at the Fall Economic Statement update, which happened at the end of December, which had some interesting notes about what might happen to the SR&ED program for the future. And then a few other updates that might be relevant to your businesses. And Grace is going to take us through some of her experience with the SR&ED program as she's used it over the years. So we'll do that for about 25, maybe 35 minutes, and then we'll take questions thereafter. Okay, so first a little bit of a view of the landscape for all grants and incentives in Canada. So today, that landscape is about $7 billion worth of incentives available from the public purse at all levels of government every year. And that encompasses grants as well as entitlements. And so on the grant side, there's about 3,000 of them at the federal, provincial, and municipal levels. And they are about $3.5 billion of that $7 billion. The SR&ED program is another $3.5 billion for the one particular program to do with R&D. And then in addition to that, the new decarbonization funds, which are also in the form of an entitlement, when they get to their run rate, they're intended to be about an $8 billion a year funding mechanism. So when we see all of that happen, we're talking about $15 billion a year. Some of these are small, some of these are big. The current government has shifted a lot towards direct funding through grants and less through the ITC mechanisms. Prior ITC mechanisms before the new decarbonization funds. And you know, the grants, the programs are open and they close. You got to be paying close attention to that aspect of it, as well as they have very specific criteria for what they're asking for. So you got to have a project that hasn't yet started that you think needs some funding to kick it over the goal line, and be able to plan that far enough in advance that you can apply for and get that kind of funding. Whereas the entitlements, you spend the money and then you apply for that with your tax returns. So these are all the criteria generally that governments use to incent people. CapEx that they're looking to build out in a particular area. The one we're going to talk about today is R&D projects. And of course, of late, in the last 4 years, a lot of funding associated with the environment. But generally, these are the reasons that government would put money in. Okay, so then we'll move to the SR&ED program. So it's a long-standing program. It's been around since the mid-1980s. It's owned by the Federal Ministry of Finance, but it's adjudicated by the Canada Revenue Agency. And as such, the rules are codified in the Income Tax Act. There's only one page in the Income Tax Act, and the next few slides are reprintings of what is on that single page. So it bears knowing exactly what the words are from the Income Tax Act. If you print it out, though, all of the policy documents that have been written in the last 40 years about it, it would fill up like a 4-inch 3-ring binder. So there's a lot of interpretation for one page in the Income Tax Act. What it gives is cash refunds or tax credits for expenditures that people have made in Canada, specifically to do research and development, and specifically in Canada. So those are two of the criteria. CRA puts out statistics on this. The last is for budget year 21-22. As I said earlier, it's about $3.5 billion. And there are a variety of sizes of claimants. There's 21,000 claimants across the country, from people doing R&D in their basement all the way up to multinational corporations. We're going to give you these slides, by the way, and so you'll be able to see what we've been talking about. If you want more information, the government website is shown below. You can click that link and it'll take you to their information on the site. So first of all, what's it worth? So you get two things from the program. You get a current deduction for eligible expenses, just like you would for any other kind of current expenditure. And in addition to that, you get something called an investment tax credit, or ITC. And that is as follows, right? It is for smaller companies, you get 35% of what you spent in eligible things as cash, as an ITC on all your SR&ED expenditures. If you're a large corporation, you get 15% as non-refundable ITC, or a credit against income taxes that you owe at the federal level, which can be carried forward for 20 years. So if you don't owe tax today, you have 20 years to get to a point where you do owe federal tax, and then you can apply these as cash. Or if you happen to be taxable 3 years ago and hadn't used these things, you can amend your tax returns and use them for taxes that you already paid if you're in that large corporation. It is for expenditures for work that you've done in Canada, and includes wages of your people, materials used in the prosecution of the R&D, any equipment that happens to be used through the prosecution of the R&D, some overhead costs, R&D contracts, so contracts you have with other people for things that look like R&D that you might do yourself, and then something called third-party payments, which are payments to things like research institutions or secondary education institutions where they're doing R&D on your behalf, where you're part of a consortium doing the work. That's a very easy thing to claim, but it has to be for a group of companies, not just your personal company. If you did that same work yourself, it would be a SR&ED contract, and then you'd have to claim it through the more rigorous part of the system. In addition to the federal benefits, most provinces have some sort of kicker on top of that. I've used Alberta as an example. So they have a program that matches the eligibility criteria. And if for a small to medium enterprises, give you at least an additional 8% as a refundable ITC on R&D spending over a particular base. And then other provinces do similar things. They basically use the federal rules and adjudicate costs with provincial tax authorities. So here's an example of how this calculation would work for both a small and a large corporation who happens to be doing work in Alberta. So on a percentage of a dollar spent basis for salaries, you'd get 59.9% as a small private corporation, which is that 35% rate plus the amount that would be included from the province, and times what is known as a proxy rate. So you can make the calculations two ways. You can either use the salaries that you pay as a proxy for overheads and multiply the salaries by 1.55, or you can actually figure out what the overheads are and claim them directly, and that's called the traditional method. So this example uses the proxy method. For large corporations, for salaries, you get 23.3%. For subcontractors, you get 80% of whatever the rate is. So that's how you get to 32.6% for small corp and 12% for large corp. And then for materials, it's straight up 40.2% for small private corporations and 15% for large corps. So you can see that while the face value of this might be 35 or 15%, depending upon the size, using the proxy method, and if most of what you're doing is labor-based, it actually is quite lucrative. You get up to nearly 60% as cash for small private corporations and almost 25% for large corporations. So then how do you get eligible? So here is the definition from the Income Tax Act. It's in subsection 248.1 in the Income Tax Act, and the next couple slides are the exact words from the Income Tax Act. So as the name belies, it's the Scientific Research and Experimental Development Tax Credit. So there are two components to it. One has to do with scientific research and the other experimental development. Most people know what scientific research is. It looks like science that gets done in a university setting. And there's two parts of that. So basic research and applied research. The only difference between the two, because they look the same, they look like laboratory type research, is that basic research doesn't necessarily have a reason for doing it in view when you undertake the work, whereas applied research does. The researchers are doing it for a purpose. So both of those are eligible as scientific research. They make up about 5 to 10% of the work that generally the CRA sees that makes up the $3.5 billion that they give out every year. So not a big piece of it. The part that is big is experimental development, and that's more of a contrived definition. So it bears going through the exact definition. Unlike scientific research, what everybody generally knows what it is, experimental development is contrived. And there's a two-purpose test for it. They are giving you the tax credit for doing experimental development, which is basically for achieving a technological advancement. That is the thing they're giving you the tax credit for, the achievement of a technological advancement. And so in this two-purpose test, the purpose that they're giving you the tax credit for is achieving the technological advancement. And the purpose of that body of work is either creating a new or improving existing materials, devices, products, and processes, including incremental improvements there too. So from a business perspective, you're coming at this from a requirement to create new or improving existing materials and devices. But if you can show them what the technological advancement is, the other purpose, that's what they're giving you the money for. It also says these improvements don't have to be paradigm shifting. They can be small in nature. You just have to be able to describe what the technological advancement is. So that is experimental development. Now, sometimes the actual activities associated with this are not that expensive. The achievement of that technological advancement could be something that only takes days to do. So the money is not going to be big. So what they allow you to do is layer on this other work. And these 8 things in section D, the next part of this slide, are the things that you can cost out, and then they are the expenditures associated with this. So engineering, design, operations research, mathematical analysis, computer programming, data collection, testing, or psychological research that is for the prosecution of the R&D. So all those kinds of activities, you can claim those buckets of activities. I've kind of highlighted in green the ones that are the ones more prevalent for people to do. It also shows that you can do this work experimentally, i.e. physically through doing experiments like that look like grade 9 science, but you can also do this by analysis, like mathematical analysis or computer analysis. So there's 2 paths in order to get a activity included as something that's eligible. Okay, so then there are some limits as to what is not included. So nothing to do with marketing or sales promotion, routine quality control or routine testing. And if you noted on the last side, one of the things that's includable under D is testing, but then specifically excluded is routine testing, and K, routine data collection. They're both excluded. It's just saying that if the testing is only for creating products that are for sale, then you can't include those costs. But if it's for both, then you can include it for R&D. So they're just kind of making sure that you know that, so what you know the limits of it. And then another limit that would be important to you is commercial production of something new. So basically saying that you need to complete your R&D, and R&D generally is ending when commercial production of something happens. It doesn't mean that you won't have a reason to do more to improve your products down the road, but the actual commercial production is not includable as costs. And so then how do you make a claim? So you make a claim with your tax return every year. So for 2024, the expenditures you would have collected during the year, the first time your taxes are due would be June 2025 if you have a calendar year end. So with your tax returns, you'd make a claim for the SR&ED program. You do have a further year in order to do this. So the expenditures for 2024 would be first due in June of 2025, but then you have to the end of June 2026 in order to make the claim before you can't make one. It is the most punitive thing in the Income Tax Act. You know, other things you can claim late and pay a penalty, but with respect to SR&ED, you get 18 months after your year end to make the claim, or you lose it. So at this point in time, if you've got a calendar year type of a business, you can claim back to the beginning of 2023 and amend your tax return by June the 30th of 2025 in order to get your costs in. So there's 2 aspects of this, a technical aspect and an accounting aspect. The document I'm showing here is on a project by project basis. You have to explain to the government from a technical perspective why you think that this is eligible for the program. And this document is what you use to put into your income tax return to show that. It's basically 1,400 words with some radio buttons and other boxes for things you have to fill in. But the big part of it is to describe the technological uncertainties associated with the work and also the systematic investigation or what work you did in order to resolve those technological uncertainties, and then describe the advancements. The easiest way to do this is to do section 244 first. So describe to yourself all of the things that you did in a particular year to advance the investigation associated with some body of science or technology. And once you've got that, you can separate the things that don't seem like R&D from the things that do. And generally, it will lead you to know what the uncertainties were so that you could describe those. And then you can write the section 242 to describe those uncertainties. And then the resolution of those technological uncertainties are called a scientific advancement. So once you've got the uncertainties down, then solving the problem is more easy to describe, and then you can fill in section 246. And you have to do that for every single one of their projects. In addition to that, there's lines in your income tax return to put the costs associated with these in there, the materials, the labor, all that kind of stuff in a prescribed way. So when the CRA is adjudicating this stuff, this is what they're looking for. They're looking for you to answer in a positive way these 5 questions. The first is, was there a scientific uncertainty or technological uncertainty, i.e., did you have to go beyond standard practice in order to do this? So you describe that for them. Generally, when they're doing reviews, this is what they're asking you to answer. The second is, did the effort involve formulating a hypothesis specifically aimed at reducing or eliminating that uncertainty? i.e., did you have a plan to begin with, knowing that you were going into this trying to solve a problem? And write that down. The third is, did you follow the scientific method? So did you basically use the scientific method to formulate a problem statement, figure out what ways you might overcome that, determine an experiment that you could run to overcome those uncertainties, actually do the experiment and collect data, analyze the data to determine if your hypothesis was correct or not, and then iterate on that until you are satisfied that you've completed the exercise. So they want to see that you did it like that. Then they want to know, did you get a technological advancement? So did you overcome your problem? And then lastly, there's an amount of record keeping that's associated with this. Specifically, they say a record of the hypothesis, but they will ask you what kind of documentation you kept. So it's good to keep it along the way rather than trying to do it when the CRA comes calling, because contemporaneous documentation it shows you did it. It's also easy to collect it at the time rather than try and find it after the fact. And so this is what they're really trying to see. Was there uncertainty? Did you have obstacles you had to overcome? Did you use a methodology, the scientific method, to prosecute the experiments? And what did you learn? How did you advance your knowledge associated with this? Okay, I'm just going to briefly go through the fall economic update, and then we'll get on to some tips and tricks and some tools for being part of CRA reviews that'll come from Grace. So in the fall economic update, which was at the end of December, the Liberal government committed to expand the program, which when you do the math on it would be something like 1.9 or $2 billion over 6 years, which is an 8% increase in the overall program. So they did a few things that have been a long time coming. The last time the program was overhauled was in 2012. The PC government of the day reduced some of these things. So, but inflation has made it, necessary to make some of these things bigger. It's a good idea. So they increased the qualifying expenditure limit from 3 million to 4.5 million for CCPCs. they which will then allow people to claim, instead of $1 million, 1.5, almost $1.6 million as refundable cash. So that's a good thing. They also uh, phased out the capital thresholds and increased them. So instead of it being $10 million and $50 million, they're now 15 million and 75 million, between the time that, if you're a Canadian controlled private corporation under the expenditure limits, where you get the full 35% as cash, to where you transition to a large corporation where you get 15% as a tax credit. So also a good thing. They decided to reintroduce capital expenditures, so capital for R&D. That was removed in 2012 by the PC government of the day. That is about $400 million worth of an add back associated with this per year, which would be a good thing, because many big type projects need capital associated with this, and it wasn't a good thing that they removed it. And then they also made some Canadian public companies eligible. So that is an interesting new thing too, that's been asked for many years. Also, with the fall economic update, they added the methane pyrolysis as a proposed new pathway for the clean hydrogen ITCs. They codified the electrical vehicle supply chain ITC, and they made some additional provisions for the clean electricity ITC. And I think I'm going to stop there. Grace has a point she'd like to make about the clean manufacturing ITCs, and then we can just talk through Grace's experience with the program to date.
Thank you, David. Yes, the clean, there's a clean manufacturing ITC that David didn't mention there, that is eligible starting 2024. So I know my accountants have put it in, even though there's no formal schedule that has been developed for it yet. So that's just a heads up for those who are doing clean tech manufacturing, which almost everyone in the hydrogen industry would probably be eligible for. I just want Attorney and David invited me to talk about the SR&ED program, because I've been audited twice. So the first time was I think in 2016. At that time, I was doing the T2 myself and submitted all the documentation. So it was me and a SR&ED person going through it line by line. And one of the things that you have to be careful of is accumulated holiday pay. So that is shreddable, but you have to use it within 6 months, that holiday pay. So if you accumulate it and just continued for like a year, like a management of a small SME doesn't have time for the luxury of holidays, it accumulated, and that had to be taken off. So that's something that through our first audit, that was really the only major change that was done. Considering all the transactions, it was actually fairly pain-free. The second time, I had a more formal accounting team, and it was a accounting firm that did our T2, and that's where the questions that David went over became more in question. So they send a technical team to go through, do you have a hypothesis? Do you have a methodology to give you data on the hypothesis? Are you collecting the data on hypothesis, and what is your results? So you have to have a sort of a chain on that, and as well, it's really useful to have timesheets for your staff to talk about that. A lot of people don't. At that time, we did, so it was relatively easy as well. So they the audits don't have to be painful, but if you don't have the good documentation, it can be quite grueling. So I think I'll open it up to the audience for questions, because it's usually in the Q&A where you get to the nitty-gritty.
Mhm.
Do you agree, David?
I agree. Yeah, let's do that. So, Attorney, you're going to moderate. You're going to determine if there are questions and ask away.
So I've allowed everyone to turn on their mics and cameras. If you would like to ask David and Grace your questions, please feel free to raise your hand now.
You were so clear and succinct, David, that nobody has any questions.
Yeah, it doesn't sound hard, but like when you actually start prosecuting it, it gets hard, right? Doesn't it?
Yeah, yeah.
So
The schedules are not intuitive. One thing you
so I
didn't
have a
mention
question of
in
my
the,
own.
go ahead.
Oh, I was just gonna say, go ahead, Grace.
No, one thing David didn't mention is in the form, the T661, there is a section for people who are employed and are what they call it, they're owners of the business. There's special
Specified,
terminology for that. Yeah,
specified
specified
employee.
employed.
Yeah,
Yeah.
yeah, and that's for people who, you know, that they make more than or could potentially make more than because of their ownership of the business than someone who would normally have that position if they were an employee, right? So they limit how much at the high end that you can claim for your salary associated with something. Like say you got paid out of shares and you made $10 million a year and you figured out what that was as an hourly rate. Well, you could you know, make a claim for some particular activity for, you know, two, three, $500,000. Whereas if that was an employee, it might be $10,000. So they limit that, and that's
So I think that what they do is it's 2 times or 3 times the pensionable amount. So every year the pensionable amount maximum is listed on the CRA website, and the form itself calculates it. So whatever the highest, the lowest of the two numbers, your actual salary or the pensionable amount. So Sanjeet asked, how do you account for owners? And that's how it does. The form itself accounts for the owner, and it has a maximum. Most small businesses are not paying the maximum, so you don't have to worry about it unless you're getting a ridiculous amount, which bravo for you if you do. So so there's some hands up. Oh, Sanjeet also
Corey
has a
has
question.
his
If
hand
you
up.
get rejected, what do you do? David, do you have things
sure.
for rejection?
Yeah. So they're during that first review, they're going to send a research and technology advisor and a financial auditor, and they will run the review. But at a point in time, if they give you a letter that says that they do not agree,
Oh, nothing
either
much. I was
you know,
just trying to do this dancer, but it didn't work well. But it's okay. I'm
somebody
expecting because
somebody's
eventually,
not on mute that should be. Thank you. So if you don't agree, they send you a letter that says they don't agree that what you claimed is what you deserve according to their view of the world. It could be 100% denial or even, you know, a very small denial. But if you want to fight it, there is an appeals process through the CRA. And the first level of that appeal is to talk to the research and technology advisors manager, so a research and technology manager, about your concerns. He or she has the power to overrule the RTA, Generally, in our experience, that doesn't happen because they back up their own people, and you're not really involved in that conversation. You may be, but generally not. So you don't really know exactly what got said. So that's phase one, is talking to the research and technology manager. If the issue is a process issue, you don't think you got due process, you can ask for an administrative second review, which the assistant director is responsible for. It is possible to get them for eligibility disputes, but they really say on their website it's for due process inconsistencies. So if you do get one of those, then the assistant director will run a process where he reviews all the documents and the letters back and forth about this and determines whether his people were right or not. Sometimes that does result in overturning the issue. If you get to that stage and you don't have any satisfaction, then you can go to the CRA's actual appeals process, which is a separate division with separate people. I mean, a caveat there is sometimes they don't have the appropriate technical people, so they may go back to research and technology advisors, but generally not the same one that actually did this. And they run a separate process on this. It can take a while. It can take a year for them to assign a reviewer, and then another year for them to actually give you an answer. Generally, because it's the more seasoned research and technology advisors that have moved into the roles in appeals, they do understand the system very well, and you have a very good chance of getting satisfaction. If you don't get any satisfaction at the CRA's SR&ED appeals level, then you can take it to the Tax Court of Canada. There are not that many things that go there, and that takes a while, and it's very expensive. But there is this escalation path that you can follow, which I just described.
We have a hand up from Corey.
Hi, yeah, thanks. Thanks for the presentation. It was informative. A lot of our projects take, more than a single fiscal year. And there's been some confusion when we filed our SR&ED claims as far as when we file equipment costs. If we buy equipment in 1 year and say actually do the experimentation in another fiscal year, when those equipment costs are claimed, and how to best navigate that, particularly for multi-year projects that may span 3 or 4 fiscal years.
That's fair, and that's one of the reasons why they took the capital out in the first place. You can still claim things like that would be like capital, but they're really current costs because they really would only be allowed today if they're part of a prototype or something like that that gets rendered valueless in the prosecution of the R&D. So the available for use rules do apply, but generally they're treated as current costs because capital costs, specifically that the accounting definition of capital, isn't allowed anymore, right? But you can claim things that are like that are made into prototypes or made into pilot plants and things like that. And because they're not capital, you should be claiming them when you're actually buying that stuff because they're current cost items. So that's kind of where the confusion comes into play, because you might, from a business perspective, call it capital if it was something else, but for R&D purposes, it's a current cost.
There's also the ITCs that are coming into place. So those are specifically for capital?
They are specifically for capital, and they have their own rules. If it's the hydrogen ITC, that follows the accounting available for use rules, which are quite complicated. At the longest, it's the 2 years from the time that you got the equipment or the thing that is part of the capital. that it would be deemed to be available for use, but there are quite a series of rules that are associated with that. But they are well codified. You just have to read through them to know of which rule becomes available first, and that's when you can claim that particular piece of equipment in that tax year. So that's for the hydrogen ITC. For the carbon capture one, you claim, because they think that those projects are going to take longer to get from the books to actual production, they're allowing you to claim those costs when you take delivery of something. So if you've got a unit operation or a piece of equipment or even a pipe that you take delivery of in a particular year, then that's when you claim the cost.
Thank you.
The next question is, David, can you elaborate on the eligibility for capital expenditures incentive, specifically around shared research equipment in university labs where there are academics and private sector companies both using it? Who gets the incentive? Have there been examples where a group of SMEs partners with an academic/nonprofit partner that leverage this?
So there used to be something called shared use equipment prior to 2012 that built on the capital rules for R&D capital. And that would be where something was used for a period of time for the first 2 years that it was available for use. First term shared use equipment, it would be sort of like a year. It could be, up to 1 day less than 2 years because of the rules, but generally let's call it a year. And you figured out how much time that thing was used for production and how much time it was used for experimentation. And if it was used more than 50% of the time, then you could claim 25% of the capital. If it continued for another year, the same thing would be the case, that you could claim another 25% of the capital as shared use equipment. So therefore, at the end of this, if you used something for basically 2 years in a mixture of capital and production setting, you could get up to 50% of the benefit of the capital associated with it. So if that's what you were describing or looking for, that's the answer to that question. Let me know if that wasn't the question you were asking.
Along a similar line, Laura Sablato has asked, we are a university working with private companies to develop novel hydrogen R&D using taxpayer funding, federal, provincial, and municipal. How does SR&ED apply to our private partners in this scenario? Is this work still SR&ED eligible?
So the work is, but you have to take off the government funding first. But it's not a one for one, right? Because the SR&ED program today doesn't fund SR&ED capital. So if the grants that you're getting or the low interest loans, that type of thing, if they're actually funding the capital, then those are exclusive. If the grant is funding some of the people time, then you've got to apply the grant first, remove it from the costs that are associated with what would be the basket of R&D, and then whatever's left over, you can take a tax credit on.
The next question is, we have significant government grants that more than offset all of our current year SR&ED eligible expenditures. Is there any downside to not filing as a first-time filer until next year? That is, would we need to submit the project descriptions this year, even though there is no effective claim?
Well, so there's a couple of schools of thought there, right? Like, yeah, making a claim that's a zero claim seems kind of pointless, but you're giving the CRA a heads up as to what the activities are. They have screeners that look at different criteria. One is, how big is the company? Have they made claims before? Is there a big change from this year to the previous year? for how much money they're asking for, a bunch of things like that, right? So the screeners will look at all of the submissions from taxpayers. And if it gets flagged, it may be looked at for review. But what that really means is somebody is looking at every single claim and making a determination what the risk level is and whether they are going to do a review on it, right? Generally, a zero claim isn't going to trigger a review, but at least somebody's read it, right? So there's an argument to make the claim even though you know there's no costs in a particular year. Further, though, there's an argument that like you might as well not do it until you actually have costs, because you're not going to get a determination from the CRA when there are no costs, whether they actually agreed with it or not, right? They may have read it, but you don't know whether they liked it or not, right? So my personal advice is usually you should wait till the year that you have costs, because then you're going to go through the process in the way it's meant to be gone through.
The next question is, are these programs available for companies based outside of Canada if the project takes place in Canada?
So that depends on the corporate structure of the company. If they have a permanent establishment in Canada and they have employees that are T4'd in Canada and they have business costs that are going concern costs in Canada, then you can make a claim because you have to file a tax return, right? If you don't have to file a tax return, then you really don't have the mechanism to do it, right? So it's really for Canadian companies or Canadian subsidiaries of other companies, but that are doing work in Canada.
The next question is, if you do not take a salary and take it as share options, can we make it work?
So there's ways you do that from an accounting perspective. So it's possible, but not directly possible. And it's complicated, so it bears talking about off to the side, I would suggest, because it's really fact specific.
How does Canada stack up on the world stage against R&D incentives?
So Canada was one of the first countries to have an R&D regime. Like, as I said, it goes back to the mid 1980s. At that time, there was like 4 countries or 5 countries that had them in the 80s. Today, there's 40 countries that have them. Several countries are based off the Canadian model. So the UK and the Australian regimes specifically use the Canadian model to create their regimes. So in the intervening time, there's many more countries that have something. And while we were at the top of the pack in the 80s, because of the, when you took a bunch of the criteria for how good the program was from how much money it gave out, how easy it was to get, how relevant it was to draw a bright line between actually thinking you were going to use the program and then getting the money from it, it was very good. Top 1 or 2 of the countries out of the five or so that were around at the time. Now we're about the middle of the pack, so we're not as on those metrics of is it useful. We're not in the same place as we used to be. It's some of what the Liberal government was trying to fix by giving us a heads up in the fall economic statement of what they were going to do.
Thanks, David. The next question is, how long does an audit take?
So if you're a smaller company, you submit this with your tax returns for June the 30th. They should be telling you within 3 months that they're going to do an audit, or they should be giving you your notice of assessment that says specifically in it that they've accepted the SR&ED as filed. Right? So it's going to take 3 months for them to let you know. As a small company, it'll take longer for bigger companies that they want to do an audit. And then depending upon how many technical questions they have and how many accounting questions they have will be how long it takes. If it's a relatively simple one, it may take 2 months to resolve. And obviously, if it resolves successfully and you're happy with the result, then you're not going to take it farther into the appeals process. So it could be as short as that. It might be a few more months than that if there's some back and forth. You've got to give them documentation, and then there's a meeting, and then there's a month for them to give you in writing the answers that they've come up with. So 3 months to get to audit, 2 to 4 months to have an audit for a small company, assuming that it's acceptable to you, and then drive on. It would be multiples of that for bigger companies.
Next question is from Megan. Are any of the other ITC programs refundable?
So all of the clean economy ITCs are refundable as cash. So all of those ones are. There's only a few instances of entitlements that are used by Canada. The biggest one is the SR&ED program, which, as we've said, if you're smaller, it is cash. If you're bigger, it's an investment tax credit against taxes owing. And there are another couple of them. There's the Atlantic Canada ITC for doing infrastructure and other types of projects in Atlantic Canada, which is also an ITC. And there's the C3I program in Quebec, which is another program that is an ITC-based program. So the new clean economy ITCs are the fourth incarnation of where Canada has used investment tax credits, and they're intended to be cash for every company.
We'll round out the webinar. Do you expect any changes in the future to the program with the new UCP government, different if it is a Liberal government?
Yeah, so there's a lot of debate about that recently. If we have Carney or another Liberal leader who wins the election, he has specifically come out and said there's a few things he's going to change. One is the Part 1 fuel tax, so the tax we all pay in the fuels that we're buying, gasoline at the pump, natural gas that is delivered to our house, that type of thing. Because he doesn't see a bright line between that tax and it changing behaviors, because it's not really well understood. So he put something else in. He would keep the Part 2 tax, which is for large emitters. And since he's kind of on record as saying he wants to do things that the Liberals have already got in their arsenal, you can probably expect that he make the SR&ED changes the way that they've been tabled in the fall economic statement. That is probably not the case if there's a UCP government. They're on record as saying that they're going to cancel the Part 1 tax. They either may repeal the Part 2 tax or cut it off and leave it at the $80 a ton mark for that tax as it sits today, as examples. Since they changed the legislation in the first place 13 years ago, they probably will not move forward with any changes that enhance and add to dollars that are given out for the SR&ED program. And they intend to cancel the Canada Infrastructure Bank too. They're on record as saying that. So we can expect a bunch of changes just from that. The reason for those ITCs, the Clean Economy ITCs, were a response to the Inflation Reduction Act in the U.S. And there's a lot of very recent rhetoric, like in the last couple of days, that that up until this point, for the first 20 days of the Trump presidency, people did not think that there was going to be much done with the parts of the IRA that were already in effect. He may not push forward with the legislation for the parts that are not. But very recently, our tax people in Washington are saying, no, he's definitely looking to cut back on the ITCs in the US, which then, of course, you could say, well, the reason that we have them is because of them. Maybe we'd be doing something too. So it's very volatile times in respect to that.
Thank you so much, David and Grace. That marks the end of our webinar. Thank you so much for attending today. The recording of this will get posted on our website after, and you will be receiving an email shortly from me with the slide deck that David used today, as well as with Grace and David CC'd if you have any further questions. Thank you again, and have a great rest of your day.
All right. Thank you all.